Okay, retirement savings. We all know it's a necessity, right?
Right.
But sometimes it feels like, well, bit of a mystery. Today, we're trying to crack the code on IRAs. We're pulling back the curtain on the latest rules for 2024 and even looking ahead to 2025. The goal is to show you exactly how to maximize your contributions. We're talking individual retirement arrangements, IRAs. And our mission here is simple. Cut through the jargon, give you clear, actionable insights. We've sourced this directly from, authoritative tax guidance, so you can trust you're getting solid, reliable info.
Yeah, and it's fascinating, isn't it, how these seemingly small annual decisions, like where and how much you contribute to an IRA, they can have really monumental tax advantages and huge long-term impacts on your financial future. Whether it's about getting tax deductions now or, the incredible power of tax-deferred or even completely tax-free growth later, these are powerful tools. Our goal today is really to connect those dots for you, show you not just the rules, but why they actually matter for building your wealth.
That's a great point about the long-term view. So let's dig into that foundational piece, the
Right.
traditional IRA. First up, who exactly can contribute and what kind of income qualifies you?
Okay, for a traditional IRA, the basic rule is pretty simple. You or your spouse, if you're filing jointly, you must have taxable compensation for the year. And here's a crucial update, really a game changer for a lot of folks. For tax years after 2019, as long as you're earning income, there's no age limit to contribute.
No age limit. That's huge.
It really is. So if you're still working at 75, maybe part-time, you can still put new money into a traditional IRA. Now, compensation, what does that mean? It's primarily what you earn from working. So wages, salaries, tips, commissions, self-employment income too, after certain deductions. What it does not include is passive stuff like interest, dividends, or rental income.
Yep.
That doesn't count as compensation for IRA purposes.
Okay, that no age limit rule is definitely significant. So once you know you're eligible, what about the contribution limits? How much can you actually put in for this year and next?
Right. So opening one is easy. You can do it at most financial institutions, banks, mutual funds, brokers, you name it. And a key point here, contributions must be in cash. We're talking checks, money orders. You generally can't just contribute, say, stock directly. Though rollovers, moving money from other accounts, that's an exception. Okay, limits. For 2024, the general contribution limit is $7,000.
7,000.
Yep. But if you're age 50 or older by the end of the year, you get a catch-up contribution. That brings your limit up to $8,000.
Ah, the catch-up. Good to remember.
Definitely. And looking ahead to 2025, these limits are actually staying the same. So it's still $7,000 or $8,000 if you're 50 or older.
Okay, consistent for now.
Exactly. And listen, don't overlook the K. Bailey Hutchison spousal IRA rule. This is, well, it's a really powerful way to boost your family savings. If you file a joint return, even if one spouse has very little or maybe no compensation, contributions can still be made for them, up to the individual limit. The key is that your combined compensation has to cover both contributions.
Can you give an example of that?
Sure. Let's say you earned $30,000 and you put $7,000 into your own IRA. And maybe your spouse didn't work that year, had no compensation. Your spouse could still contribute $7,000 to their own separate traditional IRA because your combined income, $30K, covers both contributions, $14 total.
Wow, okay. That's a big deal for couples where maybe one person stays home or earns less.
It absolutely is. And timing. It's flexible, too. You can contribute for a specific tax year anytime during that year or all the way up until the tax filing deadline of the next year, usually April 15th. But importantly, that deadline does not include filing extension.
So you could file your taxes in, say, March, claim the deduction, but actually make the contribution in early April.
Exactly. As long as the money is in the account by that April 15th deadline, you're good.
So what does this all mean for your money? Do you think the biggest aha moment here is that age restriction being gone? That opens things up for later career savers. And that spousal IRA rule, it really lets you leverage your combined income, boosting savings for both partners.
Absolutely. But, okay, you've made that contribution to your traditional IRA. The next really critical step is figuring out how much of it you can actually deduct on your taxes. Because it's not always automatic, especially if you also have a retirement plan like a 401k at work.
Right. That brings us to the deductions.
Mm-hmm.
How much of that contribution actually reduces your taxable income?
Mm-hmm.
Because like you said, it's not always dollar for dollar, is it? Especially with a work plan involved.
Correct. The general rule is you can deduct the lesser of your contribution or the annual limit, $7,000 or $8,000.
But here's the catch.
Exactly. The big catch is if you or your spouse are covered by a retirement plan at work, your deduction might be reduced or even eliminated completely.
And how do you know if you're covered?
The easiest way is usually to check your Form W-2. There's a box labeled retirement plan. If that's checked, you're generally considered covered for this purpose. And this is where your income comes into play, specifically your modified adjusted gross income, or MGI. It's like the gatekeeper for the deduction. The IRS uses your MGI to determine if your deduction gets phased out. So for 2024, if you are covered by an employer plan, if you're single or head of household, your deduction starts to phase out if your MGI is over $77,000. And it's completely gone by $87,000.
Okay, 77 to 87,000 for single.
Right. For those married filing jointly or a qualifying surviving spouse, that phase-out range is higher, between $123,000 and $143,000 MGI.
123 to 143, married filing jointly.
Yep. Now, married filing separately, that's a tough one. The phase-out starts immediately, basically if your MGI is over $0 and it's gone by $10,000. Very restrictive.
Wow, okay, and these numbers change, right? What about for 2025?
They do. They're ticking up slightly for 2025. For single or head of household filers, the phase-out will be between $79,000 and $89,000. For married filing jointly or qualifying surviving spouses, it'll be between $126,000 and $146,000. The married filing separately limits, though. Those stay the same, $0 to $10,000.
Got it. But what if, say, I'm not covered by a work plan, but my spouse is? Did that change things?
Yes, good question. That's a different scenario, and thankfully the limits are much higher. If you aren't covered, but your spouse is, and you filed jointly, for 2024, your deduction phases out between $230,000 and $240,000 MGI.
Much higher range there.
Much higher. And for 2025, that jumps again to between $236,000 and $246,000.
Okay, so let's say your income is too high, your deduction gets limited or even wiped out. What happens then? Is that contribution just wasted?
Not wasted, no, but this is really important. Listen closely. The part of your contribution you can't deduct becomes a non-deductible contribution. This isn't a penalty, but here's the crucial step. You must report these non-deductible contributions on IRS, Form 8606.
Form 8606. Why is that so important?
Because if you don't file that form, the IRS has no official record that you put after-tax money into your IRA. So years down the line, when you take distributions, they'll assume all of it is pre-tax money and fully taxable. You essentially end up getting taxed twice on that non-deductible amount. It's a silent killer for your retirement savings if you miss it.
Ouch. Double taxation is never good. Is there a penalty for not filing that form?
Yes, there's a $50 penalty for each year you fail to file Form 8606 when you're required to. But honestly, the bigger cost is that potential double taxation later on.
So what does this all mean? The key takeaway seems to be, if you have a retirement plan at work, your MGI is absolutely critical for the traditional IRA deduction. Don't just assume you get the full deduction. Check your MGI against those phase-out ranges. And if you do make non-deductible contributions, filing Form 8606 isn't optional. It's essential to avoid a nasty tax surprise later.
Exactly right. Calculate, verify, and report.
Okay, let's shift gears a bit. Let's talk about moving money around. Your IRA isn't necessarily stuck in one place forever, right? Life changes, jobs change, maybe you find a better investment platform. So understanding rollovers and transfers, that seems critical to avoid accidental taxes and penalties.
It really is, and there are different ways to move money, each with its own rules. Probably the safest, cleanest way, especially if you're just moving between two IRAs, is a trustee-to-trustee transfer.
Trustee-to-trustee, how does that work?
You basically instruct your current IRA provider to send the funds directly to the new IRA provider. The money never actually passes through your hands. Because you don't receive the funds, it's not technically a rollover. And crucially, it's not subject to that tricky one rollover per year rule we need to talk about.
Okay, so direct transfer is simplest. What about actual rollovers?
Right. Rollovers are when you receive the money from one retirement plan and then you have to deposit it into another eligible plan, like another IRA. The key here is the time frame. You have 60 days from the day you receive the funds to get them into the new account. If you meet that 60-day deadline, the rollover is tax-free. If you miss it, well, usually that distribution becomes taxable income.
60 days. That seems like a tight window. What if something goes wrong?
It can be tight. The IRS can waive the 60-day rule, but only for specific hardship reasons like a casualty, disaster, or maybe an error by the financial institution. It's not automatic.
Yeah.
Oh, and another tax-free way money moves is sometimes during a divorce. If an IRA is transferred as part of a divorce decree, it's generally a tax-free event for both spouses.
Okay, now, this next point, you mentioned it briefly, the one rollover per year rule. This sounds like a place where people could easily trip up.
Oh, absolutely. This rule causes a lot of confusion, let me be clear. This limitation applies to IRA rollovers. It means you can only make one such rollover within any 12-month period. And here's the kicker. It's not one rollover per IRA account you own. It's one rollover total across all your IRAs.
Wait, all of them combined. So traditional, Roth, SEP, simple.
Yes. The IRS aggregates them all for this rule. So let's say you roll over money from IRA 1 to IRA 2 on maybe January 1st, 2025. You cannot then do another IRA to IRA rollover, say, from IRA 3 to IRA 4 anytime before January 1st, 2026. It's a rolling 12-month period.
And what happens if you mess that up, if you do a second one within the 12 months?
The consequences are significant. The entire amount of that second or subsequent rollover becomes a taxable distribution. And if you're under age 59 and a half, you'll likely get hit with a 10% early withdrawal penalty on top of the income tax. One simple mistake here could cost you thousands.
Yikes. Okay, so that rule is really important to understand. Are there exceptions? You mentioned trustee-to-trustee transfers.
Exactly. That one-year limitation does not apply to trustee transfers. That's why they're generally safer for IRA to IRA moves. It also doesn't apply to conversions from a traditional IRA to a Roth IRA. Those are treated differently. And one more nuance. If you happen to roll over property instead of cash, it has to be the same property or its proceeds if you sold it that gets put into the new IRA. You can't substitute.
Got it. What about moving money from, say, an old 401k or another employer plan into an IRA? Many people do this when they change jobs.
Yes. Very common, and there's definitely a smart way to do it. The best approach is usually a direct rollover. Similar to the trustee-to-trustee transfer, you instruct your former employer's plan administrator to send the money directly to your IRA custodian. If you do it this way, there's no mandatory 20% tax withholding.
Ah, the 20% withholding. What happens if you don't do a direct rollover?
If the check is made payable to you instead of directly to your IRA custodian, the plan administrator is required by law to withhold 20% for federal income tax. So if you had $50,000 in your 401k, you'd only receive a check for $40,000. To complete a full tax-free rollover of the original $50,000 within that 60-day window, you'd have to come up with the missing $10,000 from your own pocket. Otherwise, that withheld $10 becomes taxable.
Okay, so direct rollover from an employer plan is definitely the way to go to avoid that withholding headache.
Absolutely. Now, speaking of rollovers, there's a brand new, really interesting option that started just this year, in 2024. It involves qualified tuition programs or 529 plans.
529s. I thought those were just for education.
Mostly, yes. But now, under certain conditions, you can roll over funds from a 529 account directly into a Roth IRA for the beneficiary of that 529 plan.
Wow, okay. Tell me more. What are the conditions?
There are several key requirements. First, it must be a direct trustee-to-trustee transfer from the 529 provider to the Roth IRA provider. Second, the 529 account itself must have been open for more than 15 years.
15 years. Okay, so it's for long-term accounts.
Right. Third, the amount you roll over in any given year cannot exceed the annual Roth IRA contribution limit for that year. So for 2024, that's $7,000, or $8,000 if the beneficiary is 50 or older. This counts towards their overall IRA limit. Fourth, there's a lifetime limit on these 529 to Roth rollovers of $35,000 per individual beneficiary.
$35,000 lifetime limit. Got it. Any other catches?
Yes, one more important one. The amount rolled over can't exceed the total contributions made to the 529 account, plus their earnings, before the 5-year period ending on the date of the rollover distribution. It prevents stuffing the account right before rolling it over.
Okay, that's quite a few rules, but a really interesting new option for leftover 529 funds.
It really is. And one last thing on moving money, recharacterizations. Think of this as a do-over. If you contribute to, say, a traditional IRA, but then realize maybe a Roth would have been better or you weren't eligible, you can recharacterize it. You basically tell the IRA provider to treat the contribution as if it were made to the other type of IRA from the start. This has to be done by the tax filing deadline, including extensions. And importantly, a recharacterization is not treated as a rollover for that tricky one-year rule.
Okay, so recharacterizing gives you some flexibility if you make a mistake or change your mind. So what does this all mean? These rules for moving money around, they're really powerful tools for managing your retirement assets, whether you're consolidating accounts after changing jobs, fixing a contribution mistake, or using that new 529 to Roth pathway. Knowing the how and when is crucial. It can save you real money in taxes and penalties.
Absolutely. And, when we talk about maximizing the benefits of IRAs, knowing what not to do is just as vital as knowing what to do. Avoiding the pitfalls protects that nest egg you're working so hard to build.
Good point. So what are some of these common traps? What mistakes can turn a good retirement plan into, well, a costly headache?
The biggest category to be aware of is prohibited transactions. This is basically using your IRA improperly for your own personal benefit. Things like borrowing money from your IRA, selling your personal property to your IRA, or using the IRA itself as collateral for a loan.
Using it as collateral, like for a mortgage.
Exactly, or even just pledging the account. If you engage in a prohibited transaction, the consequence is severe. Your entire IRA is treated as being distributed to you on the first day of the year the transaction occurred. It stops being an IRA. That means the whole account value becomes taxable income immediately, and you'll likely face that 10% early distribution penalty if you're under 59 and a half.
Wow, so one wrong move can blow up the whole account, tax-wise.
Pretty much. Another related area is investing in collectibles. Generally, IRAs cannot invest in things like artwork, antiques, rugs, gems, alcoholic beverages.
No vintage wine collection in your IRA then.
Afraid not. But there's an important exception. Your IRA can invest in certain U.S. minted gold, silver, or platinum coins, and also certain types of gold, silver, palladium, and platinum bullion as long as it meets specific fineness standards.
Okay, so precious metals are sometimes okay, but not Beanie Babies. Got it.
Right. Another, maybe less common, pitfall is unrelated business income tax, or UBIT. If your IRA somehow gets involved in operating an active trade or business, which is unusual but can happen maybe through certain complex investments and generates over $1,000 in gross income from it, the IRA itself might actually owe taxes on that business income. The trustee would have to file a special tax form, Form 990-T.
Okay, that sounds complicated. Let's talk about something probably more common. What happens if you just plain contribute too much? You miscalculated or didn't realize your spouse also contributed?
Yes, excess contributions. This happens. It's any amount you contribute that's over the annual limit, that's $7,000 or $8,000 or more than your taxable compensation if that's lower. The penalty for leaving an excess contribution in your IRA is a 6% excise tax. And that tax applies each year the excess amount remains in the account at year end.
6% per year. That could add up. How do you fix it?
The best way is to catch it early. You need to withdraw the excess contribution, plus any earnings it generated while it was in the account, by your tax return due date, including any extensions. If you get it out by that deadline, you avoid the 6% excise tax.
What about the earnings you withdraw? Are those penalized?
That's where there's been a recent helpful clarification. For withdrawals of excess contributions made after December 29, 2022, the 10% additional tax on early distributions will not apply to the earnings you withdraw along with the excess, as long as you do it by that tax deadline. Now, those withdrawn earnings are still considered taxable income for the year you made the original contribution, but you avoid the extra 10% penalty hit.
Okay, that's good news. Fix it by the deadline, you pay tax on the earnings, but avoid the 6% excise tax and the 10% penalty.
Exactly. You report the 6% tax if you owe it on Form 5329.
So what does this all mean? It sounds like the IRS really, really wants your retirement money to stay put until, well, retirement age. But life happens, right? What if you face an emergency and genuinely need to tap into that IRA early?
You're right. The general rule is designed to discourage early withdrawals. If you take money out of a traditional IRA before you reach age 59 and a half, you typically owe income tax on the withdrawal plus a 10% additional tax, often called the early withdrawal penalty. However, there are exceptions. And importantly, there are some new exceptions available for distributions made after December 31st, 2023.
New exceptions. Like what?
Two significant ones. First, there's now an exception to the 10% penalty for distributions made to victims of domestic abuse. There are specific rules around timing and amounts, but it provides crucial access to funds in terrible situations. Second, there's a new exception for withdrawals used for certain emergency personal expenses. Again, there are limits generally up to $1,000 per year and specific definitions of what qualifies as an emergency need.
Wow, those sound like really important changes, offering some much-needed flexibility in truly difficult circumstances.
They are. They acknowledge that sometimes life throws curveballs that retirement planning couldn't anticipate. And just as a quick reminder on age-related rules, the age for starting required minimum distributions, or RMDs, has also changed recently. It's now age 73 for individuals who reached age 72 after December 31st, 2022.
Right, the RMD age keeps creeping up. So understanding these pitfalls, prohibited transactions, excess contributions, early withdrawal penalties, and it's not about being scared, is it? It's about being empowered. Knowing the rules of the game helps you play it smart and protect your savings.
Precisely. Knowledge is power here.
Okay, we've spent a good amount of time on the traditional IRA, with its potential for upfront tax deductions. But what about the other side of the coin? What if you're thinking more about tax advantages down the road, maybe paying taxes now for tax-free income in retirement? That leads us straight to the Roth IRA, doesn't it?
It certainly does. The Roth IRA plays a different game, as you said. It's an individual retirement plan where your contributions are not tax deductible. You contribute money you've already paid taxes on. The big payoff, the core benefit, comes later. If you meet the requirements, basically, having the account open for 5 years and reaching age 59 and a half, or meeting other qualifying events, your qualified distributions are completely tax-free.
Tax-free growth and tax-free withdrawals in retirement. That sounds pretty appealing.
It's incredibly powerful, especially if you expect to be in a higher tax bracket in retirement than you are now. And another key difference from traditional IRAs, at least for the original owner, you can leave money in your Roth IRA for as long as you live. There are no required minimum distributions for the person who opened the Roth.
No RMDs. That's huge for flexibility and potential estate planning.
Absolutely. It allows the account to potentially keep growing tax-free indefinitely during your lifetime. And just like traditional IRAs now, since 2019, there's no age limit for contributing to a Roth as long as you have that taxable compensation. Oh, and a relatively recent change. Starting in 2023, employer-sponsored SEP and simple IRAs can now also be designated as Roth accounts, allowing for after-tax contributions there too.
Okay. No age limit, no RMDs for the owner, potential tax-free withdrawals. Sounds great. But there's a catch, right? Particularly around income.
Yes, the income limits. This is the critical distinction for contributing directly to a Roth IRA. While there's no age limit, your income can limit or even completely eliminate your ability to make direct Roth contributions.
This is where that modified AGI or MAGI comes back into play, isn't it?
Exactly. High earners might find themselves phased out of direct Roth contributions. Let's look at the numbers for 2024. If you're married filing jointly or a qualifying surviving spouse, your ability to contribute starts phasing out if your NGI hits $230,000. And if your NGI is $240,000 or more, you can't contribute directly to a Roth at all.
$230,000 to $240,000 for married couples in 2024.
Right. Now, if you're single, head of household, or married filing separately but you lived apart from your spouse all year, that phase-out range is $146,000 to $161,000 NGI.
146 to 161 for singles.
Yep. And again, that really restrictive category. Married filing separately but lived with your spouse at any point during the year, your phase-out starts basically right away over $0 MAGI, and you're completely ineligible if your MDI is $10,000 or more.
Ouch. So Roth contributions are basically off the table for most people filing separately but living together.
Pretty much.
Yeah.
Now, these MDI limits for Roth contributions are also going up for 2025. For married filing jointly or qualifying surviving spouse, the phase-out range will be $236,000 to $246,000. For single, head of household, or married filing separately, lived apart, it'll be $150,000 to $165,000. The married filing separately, live together limit stays at that $0 to $10,000 range.
Okay, good to know those are increasing slightly too. Now, assuming your income is within the limits, how much can you actually contribute to a Roth?
The base contribution limits are the same as for traditional IRAs. So for 2024 and 2025, it's $7,000 or $8,000 if you're 50 or older. But here's the crucial interaction. This limit applies across both types of IRAs. Your total contribution to all your IRAs, traditional and Roth combined, cannot exceed that $7,000, $8,000 limit or your compensation, if less.
So you can split it, like $3,000 to traditional and $4,000 to Roth, maybe.
Exactly. As long as the total doesn't exceed your personal limit, $7 or $7K or $8K, and you meet the income requirements for the Roth portion. And yes, just like with traditional IRAs, if you accidentally contribute too much to a Roth or contribute when your income is too high, that excess contribution is subject to the same 6% annual excise tax until it's corrected.
So what does this all mean? Roths offer that fantastic potential for tax-free growth and withdrawal, which is amazing for long-term planning. But those MBI limits are the big gatekeepers for direct contributions. You really have to know your income number to see if a direct Roth contribution is even on the table for you.
Precisely. But even if your income is too high for direct contributions, there are other ways money can get into a Roth IRA.
Like what? We talked about conversions.
Right. Conversions from traditional IRAs are a very common strategy, often called a backdoor Roth IRA contribution, although that term isn't official IRS language. You contribute to a non-deductible traditional IRA, since your income is too high for a deductible one, and then promptly convert it to a Roth. You'll owe taxes on any pre-tax money converted, but future growth and qualified withdrawals are tax-free. Importantly, these conversions are not subject to the income limits or the one-year rollover rule.
Okay, the conversion route. What else?
Well, there are a couple of specific situations. If someone receives certain military death gratuities or service members group life insurance, SGLI, payments due to a death from injury after October 6, 2001, they can roll over all or part of those payments into a Roth IRA within 1 year. This is a special rule and doesn't count against other rollover limits. And of course, we have to mention again that new 529 qualified tuition program rollover to a Roth IRA option that started in 2024. That's another pathway for funds to get into a Roth, subject to all those rules we discussed earlier, the 15-year account age, the annual limits, the $35,000 lifetime cap, etc.
Right, that 529 to Roth is a really interesting new development. So Roth IRAs, clearly a fantastic tool, especially, like you said, if you think your taxes might be higher in retirement. Understanding these specifics, the income limits for contributions, the conversion options, that new 529 rule for 2024 and 2025 lets you really optimize your retirement savings strategy and aim for that tax-free income later.
Absolutely. And if we connect all this back to the bigger picture, these updates we've discussed for 2024 and 2025, things like the contribution limit increases even if they held steady for 2025, the adjustments to the deduction phase-outs, and especially the new rollover rules like the 529 to Roth, it really shows that the retirement planning landscape is constantly evolving. Staying informed isn't just about, checking boxes for compliance. It's genuinely about maximizing your potential and adapting your strategy as new opportunities and flexibilities emerge.
That's a great summary. So what does this all mean for you, the listener? We've definitely unpacked quite a bit today. We've gone from the basic mechanics of traditional and Roth IRA contributions and deductions, all the way through the sometimes confusing world of rollovers, conversions, and those pitfalls you need to avoid. I think for me, the biggest aha moment is just reinforcing that these rules aren't set in stone. They change. Contribution limits change, income thresholds change, new rules like the 529 rollover appear. Understanding those changes is absolutely vital for your financial well-being. And that leads me to a final provocative thought for you to mull over. Think about this. We have the R&D age pushed back to 73 now. We have new flexibility for early distributions in really tough situations, like for emergency expenses or domestic abuse victims. And we have new pathways into Roth accounts, like that 529 rollover. So the question is, how might your long-term financial strategy adapt to these evolving possibilities?
How can you use these changes not just to plan for your future self decades from now, but maybe also to address immediate needs if necessary, or even to think about future generations? It's a really dynamic space right now. As always, we strongly encourage you to review your own personal situation. These rules can get complicated. Definitely consult the official IRS resources. Publication 590A covers contributions, and 590B covers distributions. You can find them easily at irs.gov. Just search for Pub 590A or Pub 590B. And of course, if your situation have any complexity, or if you're just unsure, seriously consider talking with a qualified financial advisor or tax professional. They can help apply these general rules to your specific circumstances.